If you make over 153,000 a year, you've probably been told the Roth IRA is off limits to you. The IRS says so, most CPAs say so, the internet says so. And I want to tell you they're all wrong. Not because the rule is different, not because there's a new loophole nobody's caught yet, but because the IRS wrote the rule with a backdoor built into it. And almost nobody uses it. In the next 12, 15 minutes, I'm going to walk you through two legal strategies that let high income earners and business owners put 46,000 to 70,000, sometimes more, a year into a Roth IRA completely tax-free on the back end. No tricks, no gray area, just two moves your CPA probably never mentioned because they don't generate billable hours. By the end, you'll know which one fits your situation, what it's worth over 20 to 30 years, and exactly what to do next. Let's get into it. Let me tell you how I found this. Back in 2016, I had a friend, let's call him Jim. Jim owned a manufacturing company outside Indianapolis, about 40 employees. He was clearing 400K a year personally and maxing out his 401K every year like a good boy. And one afternoon, he looked at me and said, Mike, I'm 42. I've been saving for 20 years. I'm doing everything right, and I'm going to pay taxes on every stinking dollar I pull out in retirement. What's the move? I was no longer in the financial advisory profession, so I didn't have a great answer for him that day. I told him to talk to his CPA. His CPA told him the same thing everyone tells high earners. Roth IRAs are off limits to you. Save more in your 401k. End of story. But Jim didn't like the answer, so he kept asking and kept digging. And what I found changed how I think about retirement planning for every high income client I've worked with since, because the IRS didn't close the door on Roth accounts for high earners. They just made it so you have to go through a back door or side door. Here's the rule the IRS actually wrote. For 2026, if you're single and you make more than 153,000 a year, you can't contribute fully directly to a Roth IRA. If you're married filing joint, the line is 236K. Above these thresholds, direct Roth contributions are phased out and eventually zero. That's the rule. Now, here's what most people hear when they read that rule. I'm locked out. Roth is for people who make less than me. I'm not one of those people. I have to put everything in a traditional 401k and pay taxes later. And that conclusion that you as a high earner have to accept being a traditional 401k person for life, that is a lie. Because the same tax code that puts the income limit in place also has a sentence you've probably never read. It says anyone, regardless of income, can convert a traditional IRA to a Roth IRA. Anyone. No income limit, no phase out, no exception. That's the back door. And the IRS has had it in writing since 2010. They've tried to close it three times. Congress has refused every time. So the question becomes, how do you actually use it? Now, full disclosure, the first time I encountered this, it didn't go as planned. I wasn't an advisor. His name was Greg. He was a sole proprietor, about 250K a year. He did the textbook, Backdoor Roth, contributed 5,500 to a non-deductible IRA in January, traditional, converted to a Roth in February, clean, simple, by the book. February of the next year, Greg calls me. He says, I just got my tax return. He owed $4,800 in taxes he wasn't expecting. He shared this with me. We were confused. He had done exactly what the IRS has said to do. Why was there a tax bill? Turns out Greg had a 60K rollover IRA sitting in Fidelity account from an old 401k he forgot about. The IRS doesn't care that Greg forgot about it. The IRS treats all your traditional IRAs as one big pool. And when you do a backdoor Roth, they calculate the tax based on what's in that pool. That, my friends, is called the pro-rata rule, and it is the single biggest trap in this entire strategy. Most people who try the backdoor Roth without knowing about the pro-rata rule end up paying taxes on money they thought they had already paid taxes on. Some end up paying tens of thousands of dollars or more. If you take nothing else from this video, take this. Know about the pro-rata rule before you do the backdoor Roth. It's very important. So, is the backdoor Roth dead? Should high earners just give up? No, far from it. The pro rata rule has a fix, and once you see it, the strategy works exactly the way it was supposed to. Here's the fix. Before you do the backdoor Roth, You roll any pre-tax traditional IRA balances into your current 401k plan. Most 401k plans accept rollovers. This empties your traditional IRA slate. When the IRS looks at your IRA balance for the pro rata calculation, the answer is zero. So the entire backdoor Roth conversion is tax-free. That's it. That's the fix. One rollover, then the backdoor Roth works exactly like the IRS said it would. Greg rolled his 60K into a 401k. The next year did the backdoor Roth again, paid zero in taxes. He's been doing it every year since. And the same fix works for everyone. The pro rata rule isn't a death sentence. It's a one-step obstacle. Or if you have more than one IRA, it could be more. Once you see it, you can't unsee it. So let's walk through the backdoor Roth in 3 steps. This is the simple one, the one that works for any high earner. Step one, open a traditional IRA at a no fee brokerage. Fidelity, Schwab, Vanguard, just pick one. Contribute the maximum for 2026. That's $7,500. If you're 50 or older, it's $8,600. Mark it as a non-deductible contribution. This is important because you've already paid income tax on the money. Step two, wait a few days, then convert the traditional IRA to a Roth IRA at the same brokerage. This is one form, 5 minutes. The brokerage handles everything. The conversion itself is a taxable event, but since you just contributed after tax dollars and the account hasn't grown, you owe zero in federal tax, assuming you've handled the pro-rata rule first. Step three, file IRS Form 8606 with your tax return. This is the form that tells the IRS you made a non-deductible contribution and converted it. Without it, the IRS assumes your conversion was fully taxable and you'll get a tax bill in the mail a year from now. This is the part people forget. Don't be one of them. The whole thing, start to finish, takes about 30 minutes, costs zero in fees, puts 7,500 a year into a Roth IRA that grows tax-free for the rest of your life. Now, 7,500 a year is real money. Over 20 years, it's 7%. That's 325K completely tax-free. When you pull it out from retirement, the IRS gets zero, none, zero. 7,500 is also the small strategy, the one that IRS gives to everyone. Let me show you the big one, the mega backdoor Roth IRA. The mega backdoor Roth is the strategy business owners with a solo 401k or a 401k plan at work should be using. It lets you put 40 to 55K a year into Roth funds, not 7,500, but 40 to 50,000 or more per year. Let that number sink in for a second. Here's how it works. IRS lets you put money into a 401k in 3 different buckets. Bucket one, your employee deferral. In 2026, that's 24.5. If you're older, it's 32.5. You can elect this as a Roth, meaning you pay taxes on it now and it grows tax-free forever. Bucket two, your employer contributions. For a solo 401k, this is up to 25% of your compensation. S corp owner, it's 25% of your W-2. This is typically pre-tax. Bucket three, after tax contributions. This is the one most people don't know about. After tax contributions are dollars that have already been taxed but haven't gotten the tax deduction. They sit in a separate bucket inside your 401k. The IRS lets you put 46 to 70K, depending on your age, into your 401k total across all 3 buckets. Most high earners max out buckets one and two. They never know bucket three exists. The bucket $3 are after tax, and here's the move. You convert them to a Roth inside the 401k before they grow. The result, 20 to 40K a year of additional money going into a Roth IRA account on top of your regular employee deferral, all tax-free on the back end, completely legal, completely IRS approved. Now, quick reality check. Not every 401k plan allows after-tax contributions. Some do, many don't. The IRS rule says you can do it. The plan document is what determines whether your specific plan lets you. Here's the move. Ask your plan administrator. If you're a solo 401k owner, check your plan document. If you have a 401k, at work, send the administrator an email. I'll show you the email in a minute. But if your plan allows it, and most modern plans do, the Mega Backdoor Roth is the single most powerful retirement strategy available to high income business owners today. Now, let me address the 2 objections that come up every single time I walk someone through this. Objection one, I have a rollover IRA. Can I still do the backdoor Roth? Roth? Yes, roll it into your 401k first. Most 401k plans accept rollovers. This empties your IRA slate. Then go, the pro-rata rule doesn't apply. Do the backdoor Roth after. Objection 2. My 401k doesn't allow after-tax contributions. What do I do? You ask, here's the exact email I tell my clients to send their plan administrator. I'll read it to you here. Subject, request to enable after-tax contributions in plan Roth conversions. Hi, plan administrator. I'm a participant in plan name. I'd like to maximize my retirement savings this year. I'm interested in two features I believe the plan may not currently support. One, after tax non-Roth contributions, the ability to contribute beyond the 24/5 elected deferral limit. Two, in plan Roth conversions, the ability to convert after tax contributions to a Roth subaccount within the plan. Both features are permitted under IRC Section 402AC. Can you let me know whether the plan currently supports these features? If not, what the process would be to enable them? Thanks. Your name. So that's basically it. That email works about 60% of the time. For plans with 50 or more participants, plan administrators will often enable these features on request. Smaller plans usually need a plan amendment from the employer. If you own the business, you can usually make that change in a single meeting with your plan provider. If your plan refuses and won't budge, the backdoor Roth alone is still a $7,500 a year move. Take it. Don't let the perfect be the enemy of the good. Let me show you what this is actually worth long term. Two business owners, both 35 years old, both making 400K a year, both maxing out their retirement accounts. One uses the backdoor Roth, the other doesn't. Owner A puts 5K a year into a taxable brokerage account. Owner B puts 5K a year into a backdoor Roth. Same 7% average annual return, same 25 years. A ends up with 325K, B ends up with 325K. Same number, right? Wrong. When owner A withdraws the 325K, they pay capital gains on the growth. At 15% long-term capital gain, it's about $37,000 or more than 10%. They're known as 288K. They can take out. When owner B withdraws, they pay zero in taxes. Roth withdrawals are tax-free in retirement. The net is $325,000. That's a $37,000 difference on a $5,000 a year contribution, and that's the floor. If you're in a higher tax bracket or use a mega backdoor Roth, put $40,000 a year into a Roth, the difference over 25 years is 400,000, a million plus. Same income, same returns, same decades of work. The only difference is whether you use the back door or not. So here's what I want you to take away. The Roth IRA isn't off limits to you. It never was. The IRS built a backdoor. The IRS built a mega backdoor. Both are legal. Both are explicit. Both have been used by high income earners for 15 years. The only reason most people don't use them is that their CPA didn't bring it up or they tried once, hit the pro rata rule, and walked away thinking the strategy was broken or not right. It's not broken. You just didn't have the full picture. Now you do. If you want to see what your specific situation looks like, what you'd put in, what it'd be worth over 20, 30 years, whether backdoor or mega backdoor fits. There's a 3-minute tax check I built. It asks a handful of questions about your income, your filing status, retirement accounts, and your goals. And at the end, it shows you what you qualify. It takes 3 minutes, maybe 2 minutes. No salesperson will call. The numbers are yours. The link is below this video. Go see what you've been leaving on the table. We also have a calculator on our website. It's linked below. So you can use that and it paints, the full picture in retirement right there on a web page. Thank you. This has been Mike Wright with Foresight Wealth Advisory in Indianapolis. Have a great day.